Good morning, everyone. I have been asked to speak today about, specifically, Enhanced Capital Partners, the program that we're a part of here in DC, how we think through investments, and give you guys sort of an overall feel of again, what we do and how we invest. So I'm going to start off at the 40,000 foot level. Essentially, we're part of a program called the CAPCO program. The CAPCO program stands for Certified Capital Companies program. It's essentially a public-private partnership between DC and what I would consider garden variety private equity vehicles. And this is an innovative public-private partnership because of the way we're actually funded is through the issuance of premium tax credits that are used as an enhancement that we then sell to, in our case, Berkshire Hathaway and other entities that have premium liability or premium taxes. So it's a creative way to actually raise private equity without having a immediate fiscal impact to the state or the municipality, because those tax credits don't take effect until year I think it's 6 or year 7, something like that. As a part of a public-private partnership, the city or state gets high-risk capital that is designed to invest in local small businesses. And so there's a criteria that's created that we all have to abide by that includes things like we can't invest in companies unless they have 25% residents here in DC. 75% of the employees actually have to work here in DC. You have to be turned down by a bank, which in some cases is easy these days. And meet the SBA requirement for a small business. This criteria really is designed to try to guide this high-risk capital to a certain class of businesses that are generally responsible for hiring people and also have some pretty good growth trajectory as far as their ability to expand and grow. The value proposition to DC is that as we invest in these small companies, they grow, they hire people, and there's some terminal value to the district in years 8, 10, 12, or whatever it may be over time. So it's creative. Enhanced Capital Partners is in several different states. Just went over it. So Enhanced Capital Partners is we're in New York, Texas, Colorado, Alabama, Louisiana, Tennessee, and obviously DC. We're only one of 3 private equity funds here in DC who are part of the CAPCO program. The others are Advantage Capital Partners and Wilshire Capital Partners. Each of these funds is part of the CAPCO program. We all abide by that same regulatory criteria. And so if you're small and you think that you meet the criteria, we'd certainly love to talk to you. So we'll do equity investments, mezzanine, and debt. The unique thing about this type of capital is that it's what we call growth capital, if you will. We try to look for companies that are not startups. In other words, these aren't companies that, it's just a concept or you're in year 1, or generally speaking, pre-revenue companies. There's generally some operating history, call it year 3 through year 5, and these are companies that are looking to scale and just need an extra, bit of capital infusion to either hire people or expand or get into a different vertical that they have some access into. And so if you qualify for conventional financing, if you can get a line of credit, that is probably a way to go rather than using sort of higher risk capital. It's maybe a little bit more expensive. I'd look at this depending on the type of capital that we're going to deploy. And so if it's equity capital, in other words, if we're going to invest in your company and take an ownership stake of it, chances are we're probably going to take some time to monitor your company for a while, only because we're sort of vested in your company as well as your success. Because what we look for in equity is some sort of liquidity event, some point in time where we can exit either through an IPO, sale, mergers, something like that. But there is certainly a partnership. We would take on a position on your board and really work to actively with you to create partnerships and really grow your business. The idea being that it's higher risk, but the reward is also going to be higher once we exit at some level. Debt, on the other hand, we kind of look for a lot of the same things from underwriting criteria that a bank would look for, although we'll go into riskier debt just because of the type of the fund that we are. So obviously that goes to cash flow. Are you cash flow positive? Issues related to collateral, issues related to debt coverage, issues related to growth trajectory into markets and that sort of thing. And so from a timing perspective, it could take a couple of months depending on the type of capital that we're going to invest. And the reason we'll get into here is because we first gather information for due diligence. Once we gather and analyze everything, there's sort of a back and forth related to the negotiation of the terms. And we also have to go through a regulatory approval. So our program is sort of regulated by DC's Department of Insurance, Banking, and Securities, or DSBE. And they're the ones who actually approve our investments, and their real purpose is to make sure that we sort of comply with the legislative intent and the criteria behind the program. We're not going to go finance someone who can already receive bank financing, so we're dealing with a sort of higher risk capital overall. After we actually invest in your company, whether it's debt, whether it's mezzanine capital or equity, we are going to work with you to try to be sure your company is successful. So it's not only going to be the investment, but we would look to strategic ways to actually grow your business or help you grow it. In some cases, we may invest debt with some ability to convert that debt into equity if we see that the company is really going to take off. And so it is more than just an investment vehicle. What we like to consider ourselves are real partners, if you will, that it's in our best interest to make sure that you're actually successful, because we don't return anything unless we get money from the companies. Financing process. Right. Step one would be initial screenings, the introductory meetings, who you are, what is the business, what are your motivations, where do you see the business in year 15 back up, how do we get there, that sort of thing. So we generally ask for in our diligence request business plans or executive summaries, bios, criteria related to whether or not you're satisfying the regulatory requirements or not. This is pretty standard diligence request material. It's nothing out of the ordinary, but for some of the resident and employee requirements that we need for approval with DC. Nothing odd, financial statements, something that will allow us to get a snapshot of your company over time. So step two, we'll usually meet in person and go to your business, if it's a manufacturing business or whatever it is, get some sense of how you operate, who the management team is, and overall feel the business culture where you are. Gone over quite a bit of that already. So again, on diligence, could take 4 weeks. It could take longer. A lot of times in due diligence, there are additional questions that'll come up related to the materials that we look at. So don't be surprised or frustrated sometimes if the multiple requests come back. It's only that we're trying to gain some clarity and a real vision into your company. All right. This is the best part. So step 4 is actual funding, and after we get through the term sheet and figure out what the terms are going to be, our funding is pretty quick, and it is just that. It's simply a wire into your account. I can tell you right now that our tier 1 companies that we're sort of focused on right now are in IT, biotech, green, financial services. That's sort of our sweet spot right now. We like businesses of all types, just that would be the general focus now. Less cash-on-cash businesses, less retail-based businesses and that sort of thing. So what we really look for are companies that, given an infusion of capital, what is the probability of them actually growing and scaling to a point that not only do we meet the requirements of the legislative intent, hiring people, more jobs, more taxes, but we're also able to, give back returns to our limited partners in ways that meet expectations. And so, small group, I lead it, and we're here in DC, 2445 M Street.